Picture New York City in the summer of 1929. The air smells of gasoline and expensive perfume. It was the era of the flapper girls, jazz clubs, and illegal whiskey. But the real addiction wasn't alcohol, it was the stock market. For the first time in history, Wall Street wasn't just for the elite, it was for everyone. The celebrity comedian Groucho Marx was trading. His cook was trading. The elevator operator in your building was trading. Anyone could walk into a brokerage office, watch the numbers tick up on the board, and feel like a genius. There was a feeling that Americans had discovered a magical machine that turned paper into gold. General Electric was up, U.S. Steel was up, Radio Corporation of America surged from $85 to $500 in just 1 year. The most famous economist of the day, Irving Fisher, looked at this madness and said, "Stock prices have reached a permanently high plateau." He truly believed that the concept of poverty was extinct. But there was a visitor in New York that October who saw things differently. A British politician named Winston Churchill visited the stock exchange gallery. He looked down at the chaotic floor and felt a strange sense of dread. He didn't see prosperity, he saw a bubble waiting to burst.
How did a shoeshine boy afford shares in General Motors? The answer is a dangerous little tool called buying on margin. It worked like this. You wanted to buy $1,000 worth of stock, but you didn't need $1,000. You only needed 110%. The broker would lend you the other $900. It was free money. As long as the market went up, you were rich. But there was a fine print in the contract, a tiny clause called the margin call. If the stock price dropped, the broker could demand all his money back immediately. If you didn't have the cash, he would sell your stock instantly to save himself. By October 1929, nearly 40% of all turnover on Wall Street was fueled by this borrowed money. The entire American economy was a skyscraper built on quicksand. All it needed was one small push, one moment of doubt. And that moment came on a Thursday morning.
October 24th, Black Thursday. The market opened at 10 a.m. By 10:30, the selling began. It wasn't just a dip, it was a slaughter. The volume of trading was so high that the ticker tape, the machine that printed stock prices across the country, couldn't keep up. It was running an hour late. Imagine the terror. People in Chicago or Los Angeles were reading prices that were an hour old. They thought they were safe, but in reality, they were already bankrupt. By noon, the crowd outside the New York Stock Exchange was so thick that the police had to form a barricade. Rumors flew that traders were shooting themselves on the floor. But the game wasn't over yet. The masters of the universe decided to intervene. At 12 p.m., the heads of the biggest banks, Morgan, Chase, National City, met secretly at 23 Wall Street. They didn't panic. They made a plan. They pooled $250 million of their own money to stop the crash. They sent Richard Whitney, the vice president of the exchange, onto the floor. In a scene worthy of Hollywood, Whitney walked into the screaming crowd, calm and confident. He went to the U.S. Steel post and shouted, "I buy 10,000 shares at $205. The price was well above the market value. The floor went silent. Then cheers erupted. The bankers had held the line. The market stabilized. People went home that weekend thinking the worst was over. They were wrong.
Monday was bad, but Tuesday, October 29th, was the end of the world. This time, the bankers didn't come to the rescue. They knew the tsunami was too big to stop. They quietly sold their own stocks and stepped aside. When the opening bell rang, there were no buyers. None. Stocks that were worth $100 on Friday were being offered for $50, then $10, then $1. The air pocket phenomenon occurred. Shares were falling into a void. The Vanderbilt family lost $40 million in a few hours.
Groucho Marx, whom we met earlier, lost everything. He later said, "I would have lost less money if I had just spent it all on illegal alcohol." The ticker tape finished printing the day's trades at 7:45 p.m. It was 4 hours late. The floor of the exchange was covered in so much paper it reached people's ankles. The janitors swept up the trash. Mixed in with the buy and sell orders were torn suit jackets, broken glasses, and the shattered dreams of a generation.
The crash didn't just break bank accounts, it broke spirits. There is a famous myth that bankers were jumping out of windows in mass suicides. While there were tragedies, like the head of the Rochester Gas Company who took his own life, most people just faded away. The Roaring Twenties were dead. The champagne was gone. The flapper dresses were sold. In their place came the Breadlines. Former millionaires were seen selling apples on street corners for 5 cents just to feed their families. The Great Depression had begun. It would take a world war to finally pull America out of the darkness. The crash of 1929 remains the ultimate lesson in human psychology. Markets change, technology changes, but greed and fear, they never change. As one survivor of the crash said, "We thought we were buying the future. We were actually paying for the past."